everyone, if you're someone starting your financial journey in 2026, you might get confused. And rightly so, because today YouTube is filled with hundreds and thousands of videos on financial planning. Someone is saying buy small caps, someone is saying make money with trading, someone is saying crypto is the future, someone is saying buy gold and whatnot. Personally, it's been 10 years since I started my own financial journey. And that is where I thought, why not create a video where I can share what I would do if I have to start my financial journey from scratch in 2026 in a step-by-step manner. Consider this video as my honest advice like a brother. Alright, let's get started. If I had to start again, the first thing I would do is start with the boring stuff. The stuff I myself ignored earlier and later realized how important it was. So I would start with building an emergency fund and taking a term plan and health plan. Let me be honest. When I talk about emergency funds, insurance and all these basic things, most people find it boring and unnecessary. They are like, investment kahan karna ye batao. Insurance emergency fund ke liye to puri life padi hai. But friends, if you directly invest your money without a safety net, your entire investment journey becomes difficult. Especially when there's a correction in the stock market, you panic. That's where the first thing I would do in 2026 is keep at least 6 months of expenses as an emergency fund. And I would park this fund somewhere safe like an FD or saving account or liquid fund where I can access it anytime. The real reason to build an emergency fund is not just for emergencies only. It's more of a behavior thing. So when something unexpected happens, like a job issue, a health expense, or some family responsibility, if you don't have an emergency fund, you are forced to sell your stocks or equity mutual fund even if you are in loss because you have no choice. I've seen people exit their investment at the wrong time just because they did not have a backup. So if I were to start again, I would treat the 6-month emergency fund as mental peace, not an investment. Once that buffer is in place, investing feels easier. You don't panic in the fall. You stop continuously checking your stock prices because you know you don't have to sell them during bad times. So your decisions become more better and more clear. Next, if I had dependents, like let's say parents, spouse, kids, the first insurance I would take is term insurance. Again, it's not an investment. It's not a return generating product. Term insurance is for protection of my own family. It's simply a way of saying that if tomorrow something unfortunate happens to me, the people I care about would still live a dignified life. Usually people think that they have enough time to take a term plan. But what they don't realize is, as they grow older, the term plan premium increases. So the best time to take a term plan is when you are young and healthy. So if I were to start again in 2026, I would lock this early. Then comes health insurance. This one is even more critical. One accident or one hospital bill can completely mess up your entire financial journey. It forces you to sell investments at the wrong time, break long-term plans, or take high-interest debt when you're already stressed. Also, a lot of people rely completely on their company policy. But what they don't realize is, the moment you change your job, you lose the cover. And the worst part is, employer-provided health plans are not comprehensive in majority of cases. So I would never rely only on company insurance. If I had to start again, my first step would be simple: emergency fund, term insurance, health insurance. This is my protection layer. Once this is sorted, everything else in investing becomes lighter. You think long term, you take better risk, and you stop carrying a constant anxiety within you. By the way, I've already done detailed videos on how to select the right term plan, health plan, as well as on emergency fund. Okay, once you take care of the basics, the next question is how to invest money. Let's have a look. Before we talk about how to actually invest in 2026, there's something I want to discuss very honestly with you all. And this comes from my 10 years of experience in the market. The bitter truth about investing is, forget about making money. Majority of people end up losing money in the stock market. Because majority of people underestimate one thing, that is human behavior. So the first biggest mistake people make with investment is wrong expectation. People think that stock market is some kind of magic machine that can double your wealth in no time. The recent bull market post-COVID has attracted a lot of new investors who expect 25 to 30% return from stock market every year. Or people think that they can trade and make quick money to take care of their monthly expenses. So first of all, let's be very clear. When it comes to trading in stock market, SEBI has been publishing data for last 2 years and clearly says that more than 90% of people lose money in F&O trading. The problem is every person who start F&O thinks he or she would be among those 7-8% people who make money from trading. So for me, F&O is a big no. I would totally stay away from it. I strongly believe that the only sustainable way to make money in equity is via investment, not trading. And investment takes time. The problem is, today people are so impatient that they don't want to wait for anything. Everyone wants to get rich overnight. No wonder Dream 11 had nearly 20-25 crore users before it got banned. Now when it comes to investment, people still want high return. So they end up putting all their money in small cap, micro cap companies and even SME companies, completely ignoring the risk aspect of investing. Okay, before that, majority of people enter into the stock market only during bull run, when small caps, micro caps are making new highs and are already trading at expensive valuation. But since majority of people simply buy stocks based on tips without any research, even a 10, 15, 20% correction creates panic and they sell at loss. They have no idea why the stock has fallen. In fact, if you have the right knowledge and the company is fundamentally strong, that correction actually creates opportunity. Some people even try to hold weak companies thinking they would sell only when it comes to their buying price, and they end up losing even more money. So if I have to start my investment journey in 2026, I would invest 80 to 90% money via mutual funds. I would deploy only 10 to 20% via individual stocks. I know it may sound boring, but this is the most honest advice I can give you with my 10 years of experience in the market so far. The reason is because stock market is a deep ocean. You need at least 4-5 years to understand how to study the business, how to analyze valuation, how to separate good companies from bad companies, how business cycles work. Trust me, you can't learn all this from day one. You can only learn this with experience and time. And if you are a beginner in stock market, you'll be guaranteed to make mistakes. That would be your tuition fee in the stock market. Everyone has to pay it. Even I have paid it during my early days. But you need to ensure that you pay a small fee. Friends, it's been 10 years since I started my stock investment journey and I still feel that there is so much to learn every single day. Of course, now my investments are mainly focused on individual stocks because that's what I do full time and I absolutely love doing it. In case you still need right direction and want to avoid making investment mistakes, you can explore my exclusive series for long-term investors where I share my own investment strategies on how I have built my investment portfolio and thought process before buying and selling a stock. Again, strictly for long-term investors. So during the initial years, instead of trying to beat the market, one thing that I would 100% focus is increasing my income, building skills, upgrading myself. I always say that the best investment you can do is invest in yourself. So I would invest 80-90% money via mutual fund, let professionals manage my money, and I would focus on building my skills, learn, upgrade. Here I want to ensure that I focus on earning more money during my initial years so that I can increase my SIP from 5,000 to 10,000, 20,000, 30,000, 50,000 as much as I can. And that would happen only when you master a skill. And honestly, that's what I did. I worked hard and got a chance to move to London. That helped me make more money. Now the next question is how to invest in mutual funds. Let's have a look. Today there are more than 500 mutual funds in equity category. How do you identify 3-4 mutual funds for investment? Here majority of people end up making one big mistake. They simply visit mutual fund website or app, sort the funds from top to bottom performance and shortlist mutual funds that have generated highest return in last 1 to 2 years. But there is no mutual fund that consistently outperform the market. Also, majority of people do not understand their risk appetite and end up having only small cap mutual funds or thematic mutual funds in their portfolio, especially when they are going up. Within a few years, people end up having 10, 15, 20 mutual funds and they have no clue what to do with them. So if I had to start my investment journey in 2026, I would keep it very boring. Something like one Nifty 50 index fund and one Nifty large mid cap 250 index fund and 1 or 2 good flexi cap fund. If you still need some excitement, you can allocate let's say 10-20% in a mid cap or small cap fund. While mid cap small cap category looks very exciting, it comes with high volatility. For instance, as of today, in last 1 year, all small cap funds are showing negative return. Again, nothing wrong with the small cap category. But the problem is, majority of new investors can't handle this volatility. So even if you want exposure, keep it limited. Please note that in investment, your goal should not be to maximize returns. Your goal should be to optimize risk-adjusted return. Boring funds make that easier. By the way, I've recently done a detailed video on best mutual funds for 2026 where I've explained all common mistakes people make in mutual fund and why index fund and flexi-cap funds make a lot of sense. If you're serious about investment journey, this is a must-watch video. Apart from this, I would like to keep 10-20% exposure in the US stock market via ETF or mutual funds. The reason is because US market provides a great diversification outside India. You don't have to depend upon a single economy. On top of that, you also benefit from USD to INR appreciation. Plus, you can be a part owner in world's biggest and most innovative companies like Google, Amazon, Nvidia, Tesla, Microsoft, Apple, and so on. I've recently done a detailed video on everything you should know about US investment from India. Now, as far as investment strategy is concerned, I would invest systematically via SIP. I would simply set up a fixed amount to be invested every month. This way, I remain invested during both ups and downs. Here I would also do buy on dip SIP. So apart from my normal SIP, I would do short blast SIP where I would invest more on every, let's say, 4-5% dip or 2-3% dip. This can help increase my overall return in the long run. Now let's look at how to build a stock portfolio. As we discussed, if I have to start my investment journey in 2026, I would try to keep individual stock exposure to 10-20% only to begin with. Slowly, I'll try to learn the business model of various companies, how the business cycle work, how to analyze businesses, how to read important KPIs, what price to buy, when to sell, and so on. And this process will take a good few years. So I won't be in a hurry. Next, I would be mentally prepared to handle stock market volatility. Stocks don't go up in straight line. Every great business, even great companies fall 30-40% sometimes. The thing is, everyone likes to buy when the market is going up, but nobody wants to invest during the correction phase. In fact, the right opportunity is when the market is in correction mode and valuations are reasonable. So if you can't mentally handle a 30% fall, don't put that money in stocks. Second very important aspect is I would build a balanced portfolio across large, mid and small cap. The problem is that every investor wants to identify hidden gems that can become the next HDFC Bank, Bajaj Finance or Titan. Nobody wants well-established businesses because that sounds too boring. So what happens is people invest in unknown companies or very small micro-cap companies, especially when they have jumped a lot. And when they fall, it completely destroys their confidence. And people exit from stock market thinking that it is a gambling. Here, please remember that in stock market, your first goal is not multi-bagger. Your first goal is staying in the game. Third, I would ensure that I avoid overhyped companies. Have more of a contra mindset. So what happens is if a company posts great result, everyone start discussing it. Likewise, IPOs create massive hype. Obviously, companies spend a lot of money on IPO promotion. So retail investors want to own those business. But when everyone is talking about the company on social media, chances are high that the stock is expensive. Of course, it is easy to buy stocks that are going up. But here, majority of people make the classic mistake of investing at higher valuation. On the contrary, it's worth identifying strong businesses that are going through temporary pain and valuations have corrected. I've recently started a series on contra investing where we discuss many interesting businesses. Fourth, I would avoid over diversification. Since I'm investing only 10-20% of my money in individual stocks, there's no point having 40-50 stocks. In that case, I won't be able to track them and I would have no idea what's happening in the business. So I would start with let's say 10-15 businesses but ensure that I understand them properly and track their progress. Here one thing would be very important. Every business would go through ups and downs and during bad time you'd feel like selling the stock. This is where most people lose money. Remember that if the business is intact, price falls are just noise. But if the business is broken, accept the mistake and move on. Over time, I would learn to differentiate between a strong business versus weak business. Finally, when it comes to picking the stock, I won't run behind hot themes because hot themes changes every now and then. The easiest way to build a portfolio is by studying businesses where you can relate. For instance, I'd like to focus on consumer business. For example, take auto sector. We all can relate with two-wheeler, four-wheeler businesses. Why not study leading player in this segment like TVS Motor in two-wheeler or Mahindra & Mahindra in four-wheeler? Then one theme I find very promising is capital market. Again, something that we can all relate to. See, Indian equity market is still very small as percentage of total household saving. As more and more people start investing, you will see more demat accounts, more mutual fund accounts, more SIPs, more transaction. This will directly benefit capital market companies. Just to give you an idea, today SIP book in India is around 30,000 crore. 10 years ago, it was around 3,000 crore. I won't be surprised if it reaches 50,000 crore in the next 3-4 years. You must ask who will benefit from this theme. For instance, CDSL and NSDL are the only two companies who manages your demat account in India. Then you have BSE and NSE as exchanges, only two exchange. Although NSE is not yet listed. Then CAMS and KFintech manages mutual fund transaction and technical details. Then you have AMCs like SDFC AMC, Nippon AMC. Then wealth management firms like Nuvama, Motilal Oswal, Anand Rathi. So this is one theme worth tracking very closely. I've already discussed this theme and individual stocks in the past. Then another interesting theme is platform companies. Players like Zomato, Swiggy, Grow, Nykaa, Paytm, Policybazaar, we all can relate to. They have now become part of our household items. Yes, you can always question their profitability and it's not easy to find the right valuation, but this is one space worth tracking very closely. I've done a detailed video on platform companies of India. Now next question you may ask is, what about metals? Should you have some allocation in gold and silver? Let's discuss it. So of late, a lot of people want to invest in metals like gold and silver. And honestly, the reason is only one. Gold and silver have generated massive returns and outperformed the equity market in 2025. Since majority of retail investors blindly chase return, everyone wants gold and silver in their portfolio now. If I cut it short, if I have to start investment in 2026, I would keep a small allocation, let's say 5-10% in gold and silver. But not because they've generated crazy return in 2025. If you simply invest based on past return, you will be disappointed. The role of metal in a portfolio is protection, not excitement. Think of gold as insurance for your investment. You don't buy insurance hoping your house catches fire. You buy it so that if something goes wrong, your life doesn't fall apart. Gold plays a similar role. When equity markets struggle, let's say currencies weaken or uncertainty rises, gold usually holds its ground. Sometimes it even shines when everything else is falling. That stability is its real value. Silver is slightly different. It behaves like a hybrid, part precious metal, part industrial metal. Because of this, it tends to be more volatile. It can outperform gold during strong economic phases, but it can also fall harder during downturn. Also, the best approach is to invest systematically via mutual fund or ETF route. You have gold Bs and silver Bs for ETF. Overall, if we break down the allocation, out of 100 rupee that I need to invest in 2026, I would invest 80-90 rupee via mutual fund or ETF route. Within that, I would divide it into 3 buckets. Indian equity, where I would put 60-70 rupee, US equity 10-20 rupee, metals 5-10 rupee. Within equity, I would break it into index fund and flexi cap fund. And if you need some excitement, you can keep some allocation in mid and small cap fund. So if I just conclude, investing is not a rocket science. It is common sense. Most people think the secret to create wealth is finding the next big stock or timing the market perfectly. In reality, wealth is built by avoiding big mistakes again and again. Not screwing up, not panicking, not chasing excitement. Just staying consistent. That's why phase 1 matters so much. Emergency fund, term insurance, health insurance. These things don't make you rich. They make sure you don't become poor suddenly. They protect you from making desperate decisions at the worst possible time. And they protect your family in case of unfortunate event. Then when it comes to investing, I would keep it very boring in the beginning. Let mutual funds do the heavy lifting. I would focus on increasing my income, upgrading my skills, and growing my SIPs every year. Time in the market matters far more than timing the market. Stocks are powerful, but only when handled with patience and conviction. I would start small, learn slowly, make mistake, but make small mistake. My first goal won't be multi-baggers. My first goal would be to survive and build confidence. And yes, diversification matters. Apart from Indian equity, I would definitely keep some exposure in US along with small allocation to gold or silver. Not to chase return, but to diversify and manage risk when markets go through tough phases. And finally, remember this, your financial journey is personal. What works for someone else may not work for you. Your income, your responsibility, your temperament, everything is different. Build a system that lets you sleep peaceful at night. Returns will follow. If you get these basics right, you don't need to do anything extraordinary. Just stay consistent for 10, 15, 20 years. that alone will put you far ahead of most people. And this plan is not just for 2026. This is applicable for anyone who is starting his or her investment journey in life. Okay, let me not stress this video. If you think this video makes sense, do share it with someone who is starting their investment journey in 2026 or someone who started but totally confused how to approach investment. Also, let me know what you think about this video in the comments. I'll see you next video. Till then, take care.